Hi, it's Harry Dent on October 27th. I'm making this YouTube broadcast because I think we're at a very critical point in the markets, in the stock market. When you get near a top, you get more volatility in the market. You get a bull-bear war because you got to remember the bulls have been winning since March 2009. Every time there's a correction, the market comes back and jumps to new highs and the bulls win again. And people have learned, buy the dips. So the bulls still have this point of view. But we've been getting some worse news recently. Ebola is part of it, but I don't think Ebola is the biggest part of the news that caused the recent 9.9% or near 10% drop in the market that I've been looking for a long time to proceed atop. It's also Germany. We've been warning that Germany would underperform in 2014 because their demographics go off a cliff worse than Japan. But Germany's also, their economic minister is saying 9 to the Germans, to the ECB on quantitative easing. They don't want any more, and Germany is the largest country, the most fiscally balanced of the larger countries, and so they're really ultimately supporting the bailouts. If Germany doesn't go along with it, it's a problem. So that's what I think the markets are starting to sense, something's not so good. Now, we've got many reasons. China bubble bursting. Again, the German slowdown, and it's going to get a lot worse. The wealthy are going to stop spending over the next year or two in the U.S., many years after Homer Simpson stopped in 2008. Car sales by demographics, age 53, look to peak this year. This is probably going to be the best year for car sales. Then they go off a cliff. And on and on. We don't see getting through 2015 without a major crash. But when I look short term, and you got to remember, we use what's called technical analysis. And I also follow many people who only do that for a living. Newsletter writers and even some people I know personally. And when I was at the Irrational Economics Summit in Miami in mid-October, one of our longtime network members, Michael and Helen Hoff, they came all the way over from Australia. They've done this many times, so we love seeing them. But he sat down with me after the conference and went over. He's a trader, and he uses Gann analysis and other timing methods, and he sat down with me and spent literally a couple hours going over how this works. And I'm not going to get into that, and you don't need to know that, but Gann has kind of time and price cycles. And when you get a potential top like this and you get a correction like we just saw, 10% that we were looking for, that the bounce that comes after is likely to go on one of two time cycles, a 50% time cycle from the crash or 100%. Now that 50% time cycle would put us at Tuesday, October 28th. That's why I'm putting this out on October 27th. And you got to give a day, say, on either side. So somewhere between the 27th and 29th, there's a good chance we'll get a cycle turn. The second target would be 100% time cycle, which would hit around November 10th. So that's a Monday. So say November 7th, Friday, through maybe November 11th, Tuesday. These are two potential times where this very strong rally could peak. So if you look at the chart that we've inserted here, I think we're at one of two places on this chart if we go back to the last top in 2007. And remember, for a good while now, I've been saying, at some point you get a 10% correction in the rally, you get a move to slight new highs, but it's not followed by things like the small caps and other key indices. That's called a divergence. And we didn't see that in the last high, but I've also been warning people now in recent times, look, we had a target 2010, 2020 on the S&P, and even more so on our megaphone pattern of higher highs with a trend line through them, right at 17,250 to 300. We've been saying, people, we can't confirm it's a top yet, but this is a good place to sell because the upside on this megaphone pattern is very small and the downside gets very large because we see a crash coming. So we were telling our subscribers that the first trend line up that would say, hey, this may be more than just a correction was 1940 on the S&P 500. But the most important one was a trend line all the way back to the 2009 bottom that hit around 1850 to 1870, depending on when it hit. We broke that in mid-October. We broke that by 3%, went down to 1820. So that was a sign to me, oh gosh, this could have been a top. That greatly raised the odds. Now, just after that, guess what happens? the market comes screaming up, and that's what happens. The bulls now step back in and say, hey, we're not done yet. We're not stopping. We're buying the dips. Nobody's stopping us. We're going to new highs. Well, that rally, I expect that. So that was not, okay, that believable, but we had a confirmation rally, according to Investors Business Daily. After 4 days from the bottom, if you see a near 2% rise on rising volume, that confirms that we are in a new short-term bull market. So the market is saying both. It's saying, no, the bears won. It's saying, oh, no, the bulls are going to win. I don't know. And you got to remember, anytime I talk about technical analysis, anytime I make short-term predictions or quote somebody that makes short-term predictions from their newsletters, it's only guessing. We cannot have the same type of scientific deterministic approach as we do in long-term trends like the baby boom peaking around 2007, which happened, or car sales very likely peaking in 2014 this year, in short-term matters, because anything can happen. What somebody says in Germany, or what happens in China, or it's another tsunami in Japan, I can't predict those things short-term, but we can look at the patterns in the market and make better guesses. And I always say to investors, if we're looking to buy in at a point or to get out of stocks or an investment at a point, it's better to do it at a time when you're more likely to be right or more right. So again, we look at this chart. There's one of two places we could be if we look back to the 2007 top. We look back at, and we see from July into August, we had a sharp correction, about 10%, just like this one, and then we had a rally to new highs. Now, if you look at the first rise up, in early September, we had this first sharp movement up, and it kind of went sideways, and then it burst up to a new high. We could be where that first arrow is, part way up to a slight new high. And our targets on the megaphone pattern would be 2030 to 2040 at most on the S&P 500 and 17,400 to 17,500 on the Dow. I think it's going to be a slight new high. So the question is, do you want to hold out? That's only about 4% from here at most. Now, we look at the other side. When we made the top in early October 2007, we had another pretty sharp correction and then a sharp rally. But that rally retraced about 60-some% of the gains and then stopped and went down. That's scenario 2. I think that's equally likely here. And so if we're here, then this could be done right on this potential turning point around October 27th, 29th. So that's the thing. But note, after that rally failed, and it was just as sharp as this one, we went down, and then we went down and down and down. That was a top, and the market fell 20% within a couple months, and then had its biggest fall from June through November of 2008. Didn't take long for the market to fall 50-some%, and we're expecting a bigger drop potentially over a longer period of time. So again, we're at a crucial point. We're just guessing, but I would say there's a good chance, about a 50-50 chance, that we're going to peak right here around 1970 on the S&P, give or take. That's where the first resistance point is, or we're going to go up in the second time frame around November 7th, 11th, and make a slight new high. So you got to decide where you put your bets. But I'd say be safe than sorry. And we were saying that before this recent top. We're saying, look, 17,200 to 300 looks really good. It went to 17,350 on the Dow. That was a good place to sell, because even if we go to a slight new high, you had to suffer through a 10% loss, and we were warning about that. So that's where we're at. You look at this, you make your decisions. We're just giving you a little extra educated guessing to try to give you higher odds of getting out as close to this top as possible. And we wish you the best of success to this, but it really does look like we're getting near the end of this bubble rally.